Hello, everyone. Thanks for joining and welcome back to Wall Street Bullion. Our guest today is Graham Summers. He is the president and chief market strategist over at Phoenix Capital Research. Welcome to the show, Graham.
It's a pleasure to be here, Ivan. Thanks for having me.
Yeah, thank you for coming down. This is your first time, and I wanted to, just dive in to, what's happening in this precious metals market.
Sure.
How do you see things shaping up in the gold and silver markets? What's in store for 2026?
Sure. I think the simplest way to think about this is you have to apply certain time frames. While we're recording right now, gold and silver are currently in the middle of a correction. As you well know, nothing goes straight up or straight down with the markets, and we've had really incredible runs in both of those precious metals. So we actually unloaded almost all of our precious metals holdings about 2 weeks ago in anticipation of this. I don't think that the corrections are over just yet. The reason I say that is because from a purely kind of price action analysis perspective, when you get really severe sell-offs that are really sharp, like the one we're currently experiencing, it takes time for those to get digested. You don't really get V-shaped bottoms in most asset classes, the exception, of course, being stocks, because typically the Fed or some major, policymaker group will intervene to try and get that V-shaped bottom. But you don't typically see someone intervening to get gold to go back up. If anything, policymakers want gold, down. So we believe that we're probably going to see some chop here for a while. I read recently that since the gold bull market started in 2006, the average correction is usually about 3 months in length. There was one that was obviously, like 17 months, but when you remove that, the average is about 3 months. And usually you see a pullback to about the 50-day simple moving average. So I would look at that as kind of the time to consider buying again. All of that's just here and now, long term the macro environment is very conducive to a very big run in precious metals. The thing with these assets is that they're so small that once large institutions and pools of capital move into them, they can go much further and much higher than anyone typically believes. I mean, the last major gold bull market was in the 70s. Gold went up almost 2,000% by the time the dust had settled.
Hmm.
So, long term, we've got a lot of things that are in gold's favor. It's very clear that policymakers have opted to have an inflated away approach to the debt issues in our country and, globally. It's also very clear that we see groups now buying gold and silver that have never bought it before. Obviously individual investors such as you or myself or your listeners, we've been interested in gold and silver forever because they hedge against you losing purchasing power and
Right.
devaluing currency. But Wall Street, gold's like a barbarous relic, and central banks certainly haven't had any interest in it for decades, and that's now changing. You're starting to see groups like Morgan Stanley saying, forget the 60-40 stock bond, allocation, start doing 60 stocks, 20 bonds, 20 precious metals. That hasn't happened in decades. So you're starting to see institutional clients starting to move into precious metals. And then also, as I'm sure you're aware, central banks are buying about 1,000 tons a year of gold. For the first time since the mid 90s, they own more gold than they do treasuries as a percentage of their foreign exchanges. So,
Wow.
we're really in a new environment for precious metals. But as investors and people looking to buy, I would caution people now is not the time to load up. You let this thing settle a little bit and then maybe look to get back into it.
Hello, my fellow silver and gold stackers. Please hit the like and subscribe button. It will really help the silver and gold community grow. It'll help this channel grow, and I'd really appreciate it. Back to the video. Graham, what got you into the precious metals market? Like, what motivated you to start getting into this?
Yeah, so I've been involved in precious metals since the early 2000s. I started off as an investment strategist at a large research house in Baltimore, Maryland. And at that time, they had a very sort of libertarian slant on things. So they always were sort of pro gold for the mere fact that the view was that the people running the Federal Reserve were going to be money printers. I mean, a lot of people sort of forget that the Fed today is nothing like it was, 40 years ago. It was only after Alan Greenspan that this kind of idea of let's just paper over everything really became, the standard for what central banks would do. And then obviously after the 2008 great financial crisis, we got our first taste of really aggressive money printing from the Fed with quantitative easing. They printed $3 trillion in 7 years.
Hmm.
And so that really sort of accelerated my interest in gold. The issue though that I caution people about is that gold, people tend to get almost like a religious fervor about gold. And if you're a long-term holder, I mean, who cares? You're not looking to make a quick buck. You're seeing this as a hedge against the dollar losing value.
Hmm.
But if you're someone who wants to just trade, or invest, or you want to make money from gold, in and out, gold's like any other asset. It goes up, it goes down. You don't want to get, married to it for the long term if your, perspective is I want to make money quick. Um, but ever since countries started severing their pegs to gold in 67 with France and then the United States in 71, gold's been a fantastic investment. It's gone up more than almost anything with the exception of stocks, but that's only if you have stocks with the dividends reinvested. If you remove the effect of dividends, gold's actually outperformed stocks since 1967.
Hmm. What's your biggest concern right now, whether it's the global economy, or you're looking specifically in the United States? What's your biggest concern that you have your eye on right now, Graham?
Well, there's always lots of problems. I kind of made a name for myself being kind of doom and gloom because I invented the term the everything bubble back in 2014. And then I wrote a book by the same name in 2017. And I sort of, for some reason, branded me as this kind of the world's going to end, everything's going to blow up kind of guy. But the reality is, I don't really think in those terms. I tend to just be aware of risks, but the reality is in the long term, asset prices tend to go up. If you look at stock market, typically is like this in the long term. And so I'm not really doom and gloom. It's more just eyes wide open and pay attention to what could go wrong.
Right.
In terms of what could go wrong right now, obviously we have a lot of froth in the financial system, but the macro setup is actually very, very positive if you think about it. People get too smart with this stuff. You want to kind of keep it, I hate to say it, but you want to really keep it simple.
Hmm.
The Fed's easing, period. The economy is still growing, period. You've got an administration that's really, really pro stocks going up, even to the point that they buy stocks themselves now, period. I mean, you've got corporate buybacks or something like $1 trillion a year. So that's just built-in buying pressure for the markets. A lot of this is very positive for stocks. And then you've also got this AI technology, which really opens the door to an insane bubble. And you throw in the fact that our economy's gradually become more and more financialized over the last 40 years. And you look at sort of some of the data points about how many people own stocks, how many people day trade. There's so many more people involved now that I was saying on a previous show, yeah, we called 7,000 on the S&P 500 back in April, which at the time seemed ludicrous because it was like 5,000.
Hmm.
But this thing can go, I mean, it can get absolutely silly. If we have a replay of the late 90s, which it looks like we could, we've got an economy that is still growing, we've got a Fed that's easing into that growing economy, and then you've got a technology that's allegedly going to change everything. Back then it was the internet, now it's AI. I mean, why couldn't we see another 1999, 2000 type bubble, which would mean, I don't know, S&P 500, 8,000, 10,000, like something just ridiculous. That seems impossible. Why not? There's that a lot of people I think got kind of scarred by 2008 and think that events like that are actually pretty common. They're not. They're maybe once a decade at that. If it's not it's like trying to bet on lightning striking. It's very difficult to do.
Right.
So, yeah. So
Very
I mean, there's a lot of potential risks, but right now the market doesn't seem to care about any of them. Let's put it that way.
Absolutely. Now, Graham, let's say someone who's coming into this market, completely new, fresh, maybe even the younger crowd,
Yeah.
and you want to give them a little bit of guidance. What would be kind of your path to guidance for them?
So it depends on their level of sophistication. If they're really novices and this is new for them, the simplest way you should think about investing is that long term, the dollar is going to lose value. And so you want your capital parked somewhere that will appreciate against the dollar. And you have, several choices there. You can go with something like gold or silver. You can go with real estate or you can go with stocks. People typically go with stocks because it's the easiest. You don't, you can open a brokerage account with $200, et cetera.
Right.
And in the long term, like if your horizon, say 10, 20 years, stocks are going to go up. A big reason for that is so much of household net worth is now tied up to the stock market that it's pretty much a matter of national security that the stock market goes up for
Mhm.
the White House and for the Fed. Because
Right.
if the stock market ever had another kind of Great Depression episode, you're talking about erasing like a third to half of Americans' wealth, which, they'll fight that tooth and nail to stop that from happening. And you don't really want to bet against the Fed because at the end of the day, they can just print money and buy the stuff.
Yeah.
So long term, it kind of doesn't matter when you buy stocks, but that has to be based on the fact that you're thinking, I'm not going to look at this account frequently. Like, this is just money I'm putting aside for 20 years from now. I don't care what it does in the next few months. If you're more like someone who's going to be watching the markets closely, you need to pick a specific metric that's kind of your measure of when to get in and out of the market. Because your goal should be, I want to ride it as long as I can, and then once the wheels come off, I want to get out of it and retain as much of my gains as I can before a bear market or crisis emerges. In the short term, the easiest method I've found to do that would be the 21-day exponential moving average. And that's essentially a price point of the last 21 days average price, but it's exponential. So it emphasizes recent price movements more. And if
Hmm.
you look at a chart of the market with that, you'll see that typically when the market breaks that line on a closing basis and stays there, that's usually a big warning sign that something is coming. And if you get out, then you're safe. Um, Now you'll get shaken out a lot because the market has a tendency to kind of break it and then come right back up.
Hmm.
But the beauty of it is that if you just get out every time that happens and then get back in when it breaks above it, when the bad thing actually occurs, you'll be out and you'll be sitting pretty. Longer term, if you're someone who's not watching closely, you're not trying to get in and out of stocks, you need something that's more longer term, like maybe I don't know, like the 24-month moving average or something like that. That's something that's going to come in handy if you just want to you're looking to buy and hold and you just want to avoid long bear markets. So my answer is like it's really pretty simple. Just find something that is kind of this is when I'm just going to sell and just make sure you stick to that no matter what anyone says. And nobody times the perfect top or the perfect bottom. Your goal is you just want to keep most of the money you make during the bull market and you want to avoid most of the losses of the bear market.
Most people think the only way you can profit from gold is when the price goes up. But what if you can earn a yield on gold paid in gold without ever even selling an ounce of gold? Instead of you paying to store your gold, you can now get paid to own it. Monetary Metals offers gold owners a chance to earn a yield on gold paid in gold up to 4% in physical ounces. That means you can accumulate more gold ounces in your account, not paper promises. Unlike dollar yields that can be slashed or go negative, a gold yield is completely different. It's a real return that has been measured and trusted for the past 5,000 years. Thousands of clients have trusted Monetary Metals to help their portfolio and help their wealth grow in gold. Join the community of investors earning a yield in physical gold annually with Monetary Metals. Click the link in the description below for Monetary Metals to find out more. Yeah, no, there's so much opportunity. I guess like what you said, it depends on your level. If you're just getting into this,
Yeah.
play it by what you feel comfortable with.
Yeah.
But Graham, I want to thank you so much for coming down and speaking to this silver and gold community and speaking to the investing community here on this channel. And this is your first time, but hopefully it's not your last. As the market develops, would love to have you back on. Where can people connect with you?
Absolutely. So you can just Google Graham Summers MBA. You'll find my Twitter or X account. I'm on Amazon. I've got two books, The Everything Bubble and Into the Abyss. Those are both available on physical copies and Kindle. And then my business is Phoenix Capital Research. We're an investment research firm, so we sell subscriptions of research reports. I guess probably if you're long term, we've got one called Long Term Alpha. That's more kind of buy and hold stock picking. And then we've got one called Private Wealth Advisory, which is much more kind of weekly swing trading for stocks and ETFs. And then we've got finally an options service called Insider Options. That's much more risky, much more kind of you're looking for big gains fast. If you're new to investing, I wouldn't necessarily touch that one. But those are all things I do to try and help people beat the markets. And we've had a lot of success. We've had a win rate of 75% since 2015. So we've
Wow.
made people a lot of money, and we take a lot of pride in that.
Yeah, no, I want to thank you so much for coming down, and I highly recommend everyone to go follow Graham, go follow their work. But yeah, I really appreciate you coming down, speaking to the community. And as the market develops, love to have you back on soon, Graham.
I'm always happy to talk. Just let me know when.
Talk to you soon.
Take care.